Hi, Michael Glennon from Glennon Capital. This week I'm going to talk to you about margin of safety, and it's an interesting topic at this point in time because we've spoken over the last few weeks how things were getting very overheated towards the back half of calendar 2016 in the small and mid-cap section of the market. Many non-traditional owners of small caps were in that segment of the market, really pushing valuations up quite high. And so what that meant for us is that margin of safety that we look for when we're buying a stock really started to diminish, and I'll explain a little bit more what the margin of safety is for the people that don't understand. So in its simplest term, margin of safety means not paying too much, and the simplest way to explain the concept is, if, for example, we bought a business on a PE of 3, it would take us 4 years if we fully debt funded the acquisition and made a bid for the whole company to buy that business outright using cash flows of the business. To make it to get a little bit more in detail in this margin of safety concept, what we may do is make sure that we'll look at the balance sheet of a business. So there'll be a margin of safety either in the assets that are in the business, in the revenue that's in the business, or in the multiple that we're paying for the business, or a combination of all of those three. So it's not one single concept. It could be any of those 3 different things or a combination of them. So making sure you're not paying too much in terms of the multiple. So for example, on the PE side of things, to use that as an example, if you're buying a business that's trading on a PE of 50, there's nothing wrong with that if you can see that in a few years' time that PE is maybe 3 or 4 times. So it might be trading on 50 times this year's earnings, but if you have a lot of confidence that the business's revenue and profits growing exponentially, that's fine. You've got a reasonable margin of safety when you're making that investment. However, paying 50 times for a business that's growing at 20% and there's a lot of volatility or a lot of assumptions you have to make about the revenue growing at a very high rate, that doesn't leave you a lot of margin of safety, and you will lose money. So our number one premise is trying not to lose money. When you're looking at a margin of safety on the balance sheet, what you want to be looking at is the asset backing of the business. And what we'll do is we'll discount the assets of the business and say, look, what is the most likely scenario if something goes wrong? So receivables we may discount because we don't think there's a high probability that we'll get all of the money that's owed to the company back in. Cash we'll treat as cash unless there's some cash burn in the business, in which case we'll discount it. So it's what the most pessimistic example of the company is and how much of a premium we're paying over the most pessimistic, or in some cases, how much of a discount we're getting the business at to what we think is a realistic asset backing of the business, stripping out things like goodwill or things that we don't think are actually achievable if we had to liquidate the business. And the third side, I guess, which is a function of the multiple that you're paying in terms of a PE, is how stable is the business. So if companies sold down, share prices has fallen significantly because there might be a one-off effect, how does that affect the long-term continuity of the business and its revenue streams and its profit? So quite often share price is affected by short-term noise, and that can provide you a good margin of safety when things are sold off, when there's a lot of noise out there and things look very pessimistic, if you're confident about the revenue and the business model that the business has got. So there are 3 areas that you can look at for margin of safety. We like to have as many of those things as possible. We're a lot more comfortable now looking at investments that there is more margin of safety because there has been a pullback in many small cap companies that are great businesses and are now significantly cheaper than where they were trading several months ago. Thanks for watching. Keep watching our videos and look at us on Facebook or YouTube if you want to find out more.